So this one right here, this was a trade I gave to the people in my mentorship. I think that was last week or last 2 weeks. Can't even remember anymore. I think it was last week. The date
Yeah.
was so 3rd of September. So that was last week. Now, what we were looking for is we basically saw a smart money SMT divergence here,
Yeah.
right here with there was an SMT divergence right here with DXY. Right here is DXY. Now, this was the price action. This was the low and the high. This was here and here. Now look at the dates. The date is down here. The date was 22nd and 27th, right? Okay,
Yeah. Yeah.
dates right here, down here, 22nd and 27th as well, right?
Yeah. Yeah.
Now, both price actions are both on 4-hour time frame. Now you can see
Yeah.
that with euro is the one above, dollar is the
Yeah.
one below. Euro came down here, created a low here, and then came on the 27th and took liquidity from the previous low. So now, because dollar is inversely correlated to euro, or
Yeah.
euro is inversely correlated to dollar, they are both inversely correlated to each other. So if this one is going up, this one is going down, right? If this one runs
Yeah.
buy
Yeah.
side, we expect this one to run sell side, right?
Yeah.
Now,
Yeah.
euro took sell side liquidity, but can you see that dollar failed to take buy side liquidity?
Exactly.
So this is called SMT divergence. When two correlating pairs, whether it's inversely correlating pair or just directly correlating to each other, when they are not moving exactly the same way, we are expecting the both of them to move exactly the same way. Whenever you see this kind of behavior, it's called smart money SMT divergence. That's what this is called. Now, this is showing us weakness in dollar and strength in Europe, right?
Euro.
Now, it
Yeah.
doesn't mean the moment we see this, we jump in and just start buying. We still want to see a break of structure, right? And in this case, you can see that we have this break of structure here on 4-hour. This is 4-hour break of structure.
Yeah.
Now, two things you can do. You can either just use this 4-hour fair value gap here as your entry, place your limit order on that fair value gap. I'll make this a different color, make it green. You can place a limit order there and use the low as your stop, then targets the overall buy side liquidity, targeting like a 1:2, target a 1:2. We have low resistance liquidity here. You can use that as your take profit. I believe you know what is the low resistance liquidity, right?
Yeah. Yeah.
Now we use low resistance liquidity as take profits. This is entry, this is stop loss. This would have been your first entry, right? I'll show
Yeah.
you the second entry. Now, your second entry, what time frame break of structure would you like to see from in here?
15 minutes.
15 minutes. So we'll go straight down to 15 minutes. So I'm just gonna focus only on euro because I've done the analysis I wanted you to see on DXY. Now, on euro, can you see that we were trending to the downside, creating all these lower highs, lower lows, and then this lower high. And then we have a lower high here, lower low, and then we'll have a lower high, and then this lower low right here. And then this right here is a break of structure, right?
Yeah. Yeah.
Now, if you took the trade, this would have been your entry. Let's say you use the high as your entry. Your stop loss will be the low. You add a few extra pips below. You can see that you would have been taken out of this trade. It literally would went straight to your stop.
Yeah.
What most traders do is when the trade runs their stop, they basically lose hope and they feel like, this trade is not going to work. But look what happened eventually. After taking that liquidity, it created another low here, another high, another low here, rallied and broke structure. And after it broke structure here, came back down, retested, and still rallied. So all you just have to do is follow your strategy. Even if you get taken out, that trade can still be a valid trade for you to take it a second time. And right here, you can see the second time you took the trade, it rallied, and now it's even delivered a 1:3. You could have caught a 1:3 with this one. So that would have been the first entry using 4-hour fair value gap. You would have gotten a 1:2. Your second entry would have hit your stop. So let's say you're risking 1% per trade. You're already up on this one, 2%. And then the other one you took a loss on, you're down 1%. So your 1%, you only have 1% profits now because the 2% you made from 4-hour break of structure. You lost 1% of that on this trade. Now, the third trade you took on the same pair, this one hits a 1:3. Now you can see that you are still up 4%, despite the fact that you took one loss and had two winners.
Yeah, yeah.
So it's all about focusing on just one pair, managing your risk. So that if you focus on only trading one pair, you see that even when you take a loss, it's easier for you to still look for your confluences to still get back in. But when you're trading multiple pairs, it's difficult for you to take multiple losses and want to go back in. Because all you're thinking at that point is, I'll blow my account.
Yeah.
So try to focus on just one pair you understand vividly well. If it's euro, you like how euro moves, you understand euro very well, trade euro. If it's USD card, you understand it very well, trade USD card. But don't try to mix everything up and trade too many pairs. Is that making sense?
Yeah, yeah, yeah.
Now, I want to ask you a question. How would you have gotten another entry from here?
So that one I'll go to 3 minutes.
Exactly. You go to 3 minutes. Price coming down here. I'll make this red. You go straight down to 3 minutes time frame. You literally know what to do. Your only challenge right now is to piece it all together. And that's what I'm going to help you to do. Piece it all together.
Yeah.
How you will use everything you literally know everything it takes to be a profitable trader. You just need to put it all together. That's all you need. So let's go to 3 minutes. When we go to 3 minutes time frame, you can see right here, we were trending to the downside and then we created this lower high here, lower low. So all you want to see is for price to break and close above this high. So you wait patiently. You wait patiently until you see that high get broken. It still now is broken. Boom. The moment that high is broken, look right here. The moment here breaks and closes, place your
Yeah.
limit order on that high instantly. Can you see that? If you fail to place your limit order there immediately, you only have about the morning broke structure, you have 3 minutes, 6 minutes, 9 minutes, 12 minutes, 15, 18, 21. You had 21 minutes to place this trade. If not, you miss it. That's all you have. 21 minutes. That's what the market gave you in this kind of scenario. Your stop loss will be the low.